I'm thinking about a seismic shock, an earthquake, where there's a number. If you had to assign a number to the Asian financial crises, the global financial crises, the COVID, and now that, what number would you give it?
Asian financial crisis, about a 3. Global financial crisis, about a 6 or a 7. COVID was a major shock. You'd put that around an 8 or a 9. This one, you're probably talking about there around a 9 out of 10.
Nick Tuffley, Chief Economist at one of New Zealand's largest banks. He's won multiple awards for accurately forecasting the economy, and he's lived through every major economic shock of the last 3 decades.
About 20% of global oil supplies and gas supplies as well are no longer being produced or shipped. A bit like, okay, you've got to go on a crash diet and stop eating 20% less food. The government can't wave a magic wand and just make the fuel bill dramatically smaller for everyone, particularly when it's running deficit still and got a very high level of government debt now.
The RBNZ is coming in and saying we might hike rates. Can you please help explain it in plain terms? The reason why we need to have the rate increases.
If you're running a business, one of the best things to do at the moment is...
Nick, why should someone click on this video and watch till the very end?
I think if you watch through the very end, hopefully what you're going to get out of this is some thoughts on what's happening in the world, why, and how that might impact on you in your life, because it's not just about fuel prices going up. We'll find other things. And it's also about really, well, what do you do?
Yeah.
Because these are these times of uncertainty where we're in situations we've never been in. And you do have to just think through, life's got to continue. You've still got to make decisions. You've still got to run businesses. And you need to still keep on doing that.
Throughout this conversation, I want to keep in mind a certain type of person who is needing an answer. It's a business owner, probably someone who has a trucking business or a service business, and they've got a mortgage, they've got staff, and they're really wondering what the heck is going on right now. Am I in trouble? Is my business in trouble? Is the economy in trouble? What do I do? So you were very optimistic at the start of the year. How are you feeling right now?
Well, I think the word for that is less optimistic. Look, we've hit like a real challenge. I think that we started this year thinking that the economic recovery was getting underway. There were some encouraging signs, and that we'd see that momentum gradually pick up over the year. So gradually. But now, look, we are facing what amounts to like a big global energy shock, and it is going to create big headwinds, not just for us, but for a lot of the countries that we export to and rely on for our incomes.
And it sounds like the shock coming to us in New Zealand is a little bit tiny, more painful than the rest of the world because we are so tiny. Could you explain how big this shock is in terms of the impact that it's having on, firstly, businesses, because this is who's listening to this podcast?
Well, what we are facing is a really big lift in the price of something that we rely on for pretty much everything in our daily lives. So many of us drive our car to go to work, go to the supermarket, take our kids to sports. We have businesses where their bread and butter is literally burning fuel to make sure that they are delivering people or goods around the country. And then there are people who rely on their packages, deliveries, turning up as part of their own business as well. And that's before we start thinking about, okay, what's going to happen to the availability and cost of plastics? Will we have enough fertilizer when we're wanting to, grow crops and grass sort of later on this year? So these are some of the ripple effects we'll need to think about.
So I understand that you've lived through the Asian financial crises and the GFC.
Yes, and we've had, I guess we count COVID in there because that was COVID. a big shock. So quite large shocks, and some of those have made quite a big difference to how New Zealand society and how the economy has worked as well. And this is another shock like that, which we don't know how long it's going to be, but it's quite profound whilst it is happening.
When you're thinking about shock, I'm thinking about a seismic shock, an earthquake, where there's a number. If you had to assign a number to the Asian financial crises, the global financial crises, the COVID, and now that, what number would you give it?
Well, if you're doing I suppose if I was doing the Asian financial crisis, nowadays I'd probably look at that if you're doing it out of 10, maybe about a 3.
Right. Okay. That's quite light.
Yes, in retrospect, it feels like it now.
Like
the global financial crisis, that was up probably around about a 6 or a 7. The Canterbury earthquakes were a lot more localised, but very profound there.
Yeah.
COVID was a major shock. You'd put that around an 8 or a 9, but the thing was it ended up being short-lived, which was a real saving grace.
Right. Yeah.
This one, you're probably talking about up there around a 9 out of 10 from the point of view of if you were thinking about one of the worst things you could have happen, it's probably, right, well, let's shut off global oil supplies to many countries because it's a hard one to step around.
This is really helpful because I had no idea it is that bad.
Look, well, we don't want to catastrophize it too much, but look, when we step back though and look at it, about 20% of global oil supplies and gas supplies as well are no longer being produced or shipped. And fuel is not an energy. It's not something where you can just easily stop using it for many of our things. And so we are suddenly facing into, hang on, this is something like a bit like, okay, you've got to go on a crash diet and stop eating 20% less food and have 20% less coffee. It's something where it takes quite something to adjust to for something that's so fundamental to your daily life.
What is the thing that, are you surprised at this? Like, from an economist, I'm keen to hear what you think about this shock. I mean, saying that it's an 8 or 9, that's higher than COVID.
It's
higher
got that,
than the GFC as well.
Yeah, I think one thing I'd with COVID say is that it was pretty profound at the time when you think about what happened. We basically shut down in effect about 30% of our economy for a brief period of time. Pretty major. But the thing was, when it ended, actually we got back to where we were very quickly, and if anything,
bounced back.
We overstimulated things and overheated the economy afterwards, which caused other problems. So it was a very deep shock, but the bulk of it was over relatively quickly. Whereas I think with this time around, well, first of all, again, we don't know how long. The war could be over tomorrow. Oil could be flowing again very soon after that. Or this could drag on. And one of the challenges also is that we're probably not going to be back to that same state we were, where you've got oil and gas infrastructure that's been destroyed.
Right.
It will take time for some oil fields to restart, even once they are confident they can ship it. And so we're likely to have lingering impacts on the cost of oil and gas globally, and a real desire to try and shift our dependence on Middle Eastern energy as well.
There's a lot of implications in that answer, right? Like there's us depending on fuel, and what does it say about the dependence on fuel? Dependence on fuel from a certain part of the world, and what does that say about the monopoly of that? For New Zealand, though, how have you seen it play out so far in businesses itself? And as an economist, what are you seeing people suffering from the most, and how are you seeing people thinking about solutions to mitigate this shock? Stop, drop, and roll. What is the equivalent of that from that?
Well, there's various bits we could break it down into. If you're looking at us as everyday people or households, we can make choices around, okay, let's not do this trip. Let's not go out and do this activity where we're relying on the car to do it. Do we take the bus to work instead of taking the car? Although that, as we know, in some parts of New Zealand, like Auckland, that can sort of travel your travel time as well. Yeah. But we may need to think about, how do we flex away from using fuel? It's a bit easier for households to do it because some of what our travel is a bit discretionary. We do have some alternatives to it. So we'll think about our spending, but one challenge is that we'll probably end up spending over more on fuel, which leaves less money left over to spend on other goods and services. And that's where you can get some of that flow through to wider businesses. If we're all pouring our money into our fuel tank, almost literally, and we have a little bit less left over to spend elsewhere, then that softens, spending in other parts of the economy. That's one part. Another part, look, for businesses, what this is doing is it's really the cost of doing business is now starting to lift. If you're right in the midst of the transport sector, you're running a trucking company delivering goods, all of a sudden one of your most significant costs has probably in effect doubled, if not more, depending on the prices you've been paying, because this has really squeezed diesel prices, pretty much more than anything, diesel and jet fuel prices. And that means, okay, I've got to somehow recover these costs at some point from my customers and pass it on to my customers. And my customers are going to need to be able to bear that cost as well. And that flows on to the people getting the deliveries of groceries. All of a sudden their freight bills are going up, and then that's getting built into the margins of what they are selling as well and filtering through. So you're starting to see these initial cost adjustments. Probably the final one is because we export a lot as well, and it goes on ships. Ships still burn basically fossil fuels. The cost of that shipping is now starting to rise. Shipping is being disrupted. And in some cases, our exports aren't really going to places like the Middle East because there's no obvious place where you can safely land the goods. So some of our exporters, say our meat exporters, are needing to look at alternative markets where they can shift product to. But that may mean more competition in those markets that you've diverted to.
I can't help but continue to reflect on the previous shocks that we've had, like COVID. COVID was an utmost halt of everything, and a lot of businesses suffered. But we had fuel. Like, fuel was okay, right?
We had fuel, we had food, we had a fair degree of government support as well. So there were a lot of small businesses. Look, if you couldn't readily operate, you were getting hit. You were getting hit quite hard financially. You had some government support to help cover employee costs, so you could at least keep people on the books, even if they weren't necessarily working. There were a lot of relief packages from banks, also out of the government as well, doing loans to support small businesses. We threw the kitchen sink at the problem at that time. We did have the sort of freeboard to do it, so we had relatively low levels of government debt as well. We were supporting the economy through something where it was an incredibly unfamiliar type of shock as well. We were quite fearful of our lives. So even if you didn't have lockdowns, you would have had some degree of hunkering at home and big impacts on your economy. From an interest rate point of view, the obvious thing to do was cut interest rates. So you had the government providing lots of money, you had the Reserve Bank cutting interest rates and easing the cost of debt servicing. And those things did provide quite a cushion. In fact, we probably overdid it, and that's why we overheated afterwards. I think the challenge this time around how do you respond to it? It's very hard to just offset the impacts for people because the government can't wave a magic wand and just make the fuel bill dramatically smaller for everyone, particularly when it's running deficit still and got a very high level of government debt now. So we just don't have the flexibility as a government to support us through. And for the Reserve Bank, it's in a rock and a hard place. It was probably going to lift interest rates late this year because it's felt they've been, I guess you could say, mildly had its foot on the accelerator to try and get that recovery going. Now it's facing a huge surge in inflation, and we'll be starting to worry that it's not just a short-term lift, but that the inflation starts to filter through and get a lot more embedded and ingrained. And that's when you go back to having that problem that we had over, say, 2022, 23, 24, where inflation got very high and very persistent, even with interest rates rising to try and cool things off.
I want to understand, there's heaps in there that I want to unpack. If we just go back earlier to how long, we don't know how long this is going to be. it's very much like COVID. We don't know how long it's going to be.
Yes, there is an element of that, and I think one thing that we need to bear in mind is that, as I said before, like even if the war stops right here, right now, there are going to be quite some backlogs, because when you think about it, it takes a number of weeks for crude oil to get from the Middle East into Asia, which is where you know, a lot of the refining is done that we rely on, and then it's got to be shipped down to New Zealand. So at the moment, we're still receiving oil that was, petroleum, which is refined out of product that arrived before the war started, in effect, because of the lags. And so when the war ends, you've got to go through this whole process of ships have got to be able to get back into the Gulf, unload all the storage that's filled up. That storage has got to be drained enough for the oil fields to start up again and start pumping. Some will be able to start straight away. Some may take months as well. So it's not going to be immediate that flow of crude oil is going to come through and get back to a level near what we were used to. And that's ignoring any damage that we've already had and any future damage as well.
So it's basically, when is the war going to end? Let's say it ended right now. How many weeks should we expect before things come back to normal, if you know?
Well, you could still have a couple of months or more before you are, I think, can be quite comfortable that oil will actually keep arriving, because one thing we've got to bear in mind is that the oil shipments into Asia, have dropped. They haven't completely dried up, but they have dropped quite a lot. And so there may be some stress on the ability to keep exporting in the sorts of volumes that, the rest of us rely on as an example. So we need to get through that. But if the war ended, you're likely to see some immediate decline in oil prices. They'll still remain high, but that at least means that we're likely to see prices at the pump respond to that, because when oil companies are setting the price of fuels here, they're doing it with an eye to basically, well, what is it costing to replace that fuel? So as you get a sustained decline in oil prices,
because it's like $3.5 per litre right now.
Yes,
isn't it? What's the latest?
It's about $3.50 for 91, give or take. And for your normal retail diesel purchaser, we're still looking at upwards of $3.90 a litre, and around urban Auckland that was probably about $1.90 a litre or so before the crisis. Big large fuel consumers will probably be paying less than that, but look, you've had that's virtually a $2 a litre increase in the price of diesel. So you can just see how fundamentally that's a big impact on a fuel which we rely very heavily on for just making our economy run.
It's incredible how much we depend on oil and fuel.
It is, but when you go back in time and you have a look at the whole industrial revolution, and what's actually created massive prosperity globally has been that discovery of burning coal to create energy. We started being able to generate electricity. We discovered oil and internal combustion engines, and all of a sudden we're able to move things around quite efficiently, develop all these petrochemicals. But we're kind of probably still in this age where you can see we've got new technology coming in with electric vehicles, renewable generation of electricity, which is probably one of the next stages of our sort of civilization and its energy uses. But for the time being, we are just still very heavily dependent on diesel. It's hard to move heavy things around a long way at this stage without relying on, we've used sail, we've used coal, now we're using oil, but it's hard to, just given the efficiencies you get out of oil, it's still, we still haven't really been able to effectively replace it for some of those important things we use it for.
All right, you guys, I also want to tell you about the Disruptive Technologies course that I am doing with AcademyEx. It's week 4. I got challenged to learn about AI by Perrin Rowland, who's the guest on the show. Okay, there's 3 things this week that blew my mind. OpenAI is shutting down Sora, which is the thing that makes videos, like amazing videos. They're shutting that down. And Disney had $1 billion deal with OpenAI due to Sora, and now it's gone. Secondly, blockchain is coming up into the surface. And blockchain is the technology that actually decentralizes everything from banking to using AI. And there's a whole convergence of blockchain and AI, and how we can decentralize AI, basically remove the power from the few companies that now hold the power to AI and decentralize it, meaning power goes into the hands of the people. So I came into this course wanting to learn AI skills, but now I feel like I'm learning all this new nuances of who's owning what and who has the power, and it's opened my mind to so much, and it's really important. And if you want to do this course, either there's an intake in July, totally recommend it. There's a link in the description or in the comments or somewhere around the video, and let me know what you think. Okay, back to the episode.
Hello, thanks for watching this video. Quick note, have you subscribed? Over 90% of people who are watching on YouTube or listening on Spotify or on Apple are not subscribed or following. Please do so now. It's so simple. The button will be around the screen somewhere. You either hit subscribe or hit the follow button or leave me a review. It will help me so much, helps me grow as a channel and support my work. So I really appreciate it. Okay, back to the episode. So if the war ended today, it would be, because I understand that we have about 6-7 weeks worth of fuel in New Zealand, and the Prime Minister came out and said, we're fine. We're not at a critical level. So we're entering now into this crisis from a weakened position, not really a strong economy position, even though you were looking forward to having a great economy and it's looking positive, but we're kind of fragile, and we had this shock that's came, and then now the RBNZ is coming in and saying we might hike rates, but is that necessary? And if it is necessary, can you please help explain it in plain terms, the reason why we need to have the rate increases for someone who doesn't quite see the relationship between that?
Yeah. So I think first of all, it's what is the role of interest rates and the Reserve Bank? So if you think about the Reserve Bank, its job is to basically keep inflation low and fairly stable. So basically somewhere between 1% and 3% sort of on average over the medium term, which you can look at as being like a few years, over a period of a few years. Mm-hmm. So that's their job, is to just keep inflation anchored. And look, from in terms of like things like your money supply, interest rates, that's really the best thing you can do with, basically money. Why is inflation bad? Look, if you've got high inflation, the people that hurts most are your vulnerable, that is your low-income people and your retirees. The cost of living is rising rapidly. Incomes may not catch up. If you're a retiree, the value of your savings, if you've got money on deposit in the bank or your own government bonds, for security of some sort of income flow, basically the purchasing power of that income also gets eroded. High inflation encourages people to borrow and discourages people from saving, because again, the value of your money is being eroded. So we've generally around the world got a view that high inflation has some large economic costs, particularly also on people who can least afford to bear that cost. Look, if you've got a house, you've got a share portfolio, you'll have some sort of insulation against higher inflation, because probably, it's not always the case, but probably there'll be at least some offset from the dollar value of those going up, and at least preserving some inflation, adjusted, purchasing power. So for the Reserve Bank, it's looking at this situation and going, okay, inflation is up. We're immediately going to see measured inflation will rise because fuel prices are one part of the CPI. So bang, that's going to go up. The cost of a number of goods will go up because the cost of transporting them will go up. So we'll start to see things like, say, food prices go up a little bit because they're reliant on being transported around. You need diesel on the farms, for example. Things like, say, your furniture costs might go up just simply because they need to be hauled around.
If I may just ask, the prices will go up because the RBNZ, they will increase, like they will raise up the interest rates, or is it because of the petrol price has gone up, therefore the cost is being carried over to the consumer, or is it both?
Well, it's really, when we're looking about inflation, what we are talking about is we're talking about the general rise in consumer goods and services. That's what that's all we're sort of talking on.
The reason why this is rising, is it because of the fuel, or the government doing things to?
It's the fuel. So it's just when we if you think about the CPI, it's just basically, imagine that you've got a basket of 300 or 400 things that you buy, and you're just measuring the cost of what those 300 or 400 things are, and all of a sudden, one of those things in that basket, which is your fuel.
For people who don't know what CPI means.
Oh, yes, Consumer Price Index. So you think about it, we're just measuring a basket of goods and services that the typical household buys, and looking in a sense of what's the average cost increase.
Like a detergent, like bread.
Those things like
tomatoes,
that.
Potatoes, everything like that.
All those things, rent, rental rates for homes is one thing, and the cost of maintaining your home.
Energy.
Like energy, your house, electricity. So your electricity and gas, and your petrol and diesel that you buy as a household as well. So it's that petrol and diesel cost, bang, straight up, and then over time we'll start to see the cost of consumer goods being pushed up because it's costing more to either move them around or make them. So that's just, in the short term, you're just going to get an inflation spike. Now, does the Reserve Bank worry about that? No, it doesn't worry immediately about that, because it can't do anything about that. That's happened in the here and now, and you're talking about a lift up in the price. And if the price just stays where it is over time, the inflation rate, which is just a rate of change, if things stop going up, then the inflation rate will naturally just fall back.
Right.
But what the Reserve Bank worries about is those high prices start to filter through into a much wider range of goods and things that are just directly affected by transport. I go to my boss and say, hey, look, inflation's high. It costs me so much to run my car now, and my grocery bill's gone up. I want a 10% pay increase. And the boss goes, well, sure, I think inflation's probably running about 15%, so I'm comfortable giving you a 10% pay increase. Gives the 10% pay increase, but then ends up having to push prices up by 10, 15%. That puts other prices up. Everybody else goes, oh my goodness.
Right. Like wages.
Yeah,
so
like
wages will go up, and salaries and things like that.
And that starts to feed on itself, because because if we all want a pay increase, but the thing is, if you get a pay increase, but that sort of underlying sort of productivity, so doing more for the same, within the same hour that you're paid for, like that's a gain. You've become more valuable because you're suddenly doing more, achieving more. So wage increases that reward that productivity mean that, basically yes, you're getting paid more, but you're producing more. So the cost of what you are producing isn't really changing. But if you get a wage increase that's quite strong, but there's no sort of real lift in the value that you're actually delivering, what you're doing is you're just making the cost of producing something more expensive. Yeah. So that impacts the cost structure of businesses.
And that's like the next level of impact.
Yeah. So if you start getting that sort of more widespread generalised inflation, that stuff starts to hang around for a long time, and the Reserve Bank will be very wary of that happening.
How fast do you think that will happen?
Well, hopefully not too quickly. Having said that, the Reserve Bank was sounding a bit more concerned about the risks when it met recently. So at the moment, we think the Reserve Bank is likely to lift interest rates in September, which is earlier than what we thought.
Not July.
Not July. We do have someone at the moment picking July, but look, it's very fluid, and we and other people could end up changing our minds on when we think the right time for the Reserve Bank, or the appropriate time is, depending, just given what we think it needs to achieve. What I would say in this environment is that you can have one person saying rates will go up at this point, rates will go up at that point. At this stage, look, everybody's got to put their hand on the heart and go, no one ever really knows what the future is anyway. But in this time, it's extremely hard, because it's just so driven by key events, and in particular around one person. Or you could say there's three governments, where their interactions and whether they decide to end the war. It makes a big difference. So just my caution for people at the moment is don't rely too heavily on, say, a particular forecast or a view. Think more of the general story behind what is going on and the risks. And if you're running a business, one of the best things to do at the moment is think through different scenarios, like what might be an okay scenario, what will be like a bad scenario, what could be the worst case scenario, and understand what that might look like for your business, and think about what actions you might need to take if you find you're going down one path over another, because that's a lot more useful than people like me sitting here going, trying to pick a date in an environment which is so fluid. So it's better to be planning and thinking about how you might respond.
Yeah. So we understand now, like, if you have a business in logistics, it's really tough.
Yes.
What other businesses out there that are really feeling the hit from the fuel prices going up so bad?
Well, I had some people in my team go through and do some work where they look at how oil prices flow through industries, which industries heavily use oil, and which industries are heavily reliant on industries that use oil. So an example would be, like, say, transport is a sector that heavily uses oil, so that's been directly affected. But there are other industries which will rely heavily on transport, so they're going to have like an indirect exposure to fuel. And when you look through it like that, it's things like your transport, your logistics areas, agriculture, some manufacturing would be some examples of sectors where they're likely to be impacted a lot more because they're more reliant on fuel directly, or more reliant on people who are heavy users of fuel. In contrast with service sectors, less exposed. There'll be some indirect exposures, but it's a lot less. So you can think about it broadly speaking. Anybody who's relying on stuff being moved around, and also to some extent people who are relying on retail spending as well, you'll get some differing impacts. And some other people in my team did some work just looking at, well, how do consumers respond when you have a lift in oil prices? And the results were pretty understandable. You end up spending more on fuel, you end up concentrating on spending on the essentials, and it's discretionary spending and some durable goods. And by durable goods, you're thinking, say, furniture, appliances. Ordinarily you think cars, but we've got people rushing to buy EVs at the moment for the right reason. But people switch their spending patterns as well, and that has ripple effects.
I want to ask a question about mortgage. I don't want it to be so specific, but I know that people have mortgages, and mortgages come up to be reviewed, to be fixed. And with all of this uncertainty going on, as an economist, what sort of advice can you give to people who are like, oh, I've got this mortgage that needs to be fixed in June, and the RBNZ is saying this, and what sort of advice can you give to people with mortgages right now? Yeah,
so I give people some generic thoughts on things to consider, because I can't give people
specific advice.
But obviously the one thing that you often get asked is what should I do with my mortgage, and when should I buy my foreign exchange because I'm going on holiday? So they're probably the two most popular questions that I get, asked by people.
Nice.
So look, one thing to think about at the moment is we're in an environment where interest rates at some point are likely to, the official cash rate, which just drives short-term interest rates, is likely to rise at some point this year, and probably a lot sooner than what people would have been thinking earlier on this year. Now, that influences mortgage rates through particularly the term mortgage rates, which is where we tend to, when I talk about term, that's where we fix for 6 months or a year or 2 years or 5 years. Now, those mortgage rates are quite heavily influenced by, in a sense, where people think the official cash rate will go in the future. So if people think that over the next 2 years, the official cash rate is going to be a lot higher than where it is now, a 2-year mortgage rate is going to be a lot higher than, say, a 6-month mortgage rate. So financial markets are already building in quite a substantial increase in the official cash rate before the end of the year. So that has meant that sort of term wholesale interest rates, which is what heavily influences the cost of providing a mortgage, those costs have gone up. So fixed term mortgages have already gone up, which means it's very hard to sort of, if you fix now, thinking you're protecting yourself from future increases in the official cash rate, it's almost too late.
Is it?
Because at the moment, the financial markets are building in that by the end of the year, the official cash rate, instead of being about 2.25%, will be sort of 3.25% by the end of the year.
Yeah, I mean, it does sound like it's going to go up, right? I mean,
it was always going to go up.
Yeah, exactly,
But,
right? So everyone knows that's going to happen at some point, like sometime between June and September. You were saying like potential June and September. So if someone is coming up to time in June, wouldn't it make sense that they would like lock in the rate now and then for 2 years, and then I don't know. Yeah, that's kind of the it's not advice. This is not advice, but helping people navigate their way around and making the best possible decision.
Yeah.
In these circumstances. Yeah.
So look, one thing for people to think about is what is your risk tolerance? You know, are you quite comfortable, say, remaining on a floating rate or a very short-term fixed rate, knowing that it doesn't protect you much or at all from future rises in interest rates? Often you can get a lower interest rate by choosing shorter terms. If you choose a longer term at the moment, they are quite high, but what they offer you is certainty. Like if you fix for 3 years, you know for the next 3 years, you don't have to worry about interest rates going up. You don't have to worry if oil prices remain high for the next year or so and the Reserve Bank cranks interest rates up to a very high level. You're insulated from that. So think through your trade-offs of what's important to you, how much is that value of that peace of mind you get from fixing from a longer term, how much is that costing you compared to, say, a shorter rate, and thinking about whether that's is worth it for you, because it is a trade-off. You get flexibility if you are floating or on a very short-term fixed rate, because your term comes up relatively quickly and you've got choice about what you do, but you don't get as much protection.
Do you know, coming from the outside in, because I'm not someone who talks about this day in, day out. This is not my main talking points. But coming in from the outside, I always think, gosh, this feels a bit like a bit of a lottery. Like, honestly, like you've got information, you can make the decision, but then at some point it just feels like lottery and luck. Like you're just... Is it that? Am I right in feeling that way? Or there's actually a proper system in place, especially when the economy is getting such a hit from such external factors that we have no control over?
Yeah, I think one of the things we find in life is that it is a lottery in a sense, and that we never know what's going to happen tomorrow. Tomorrow in many ways. Yeah. So think about your mortgage interest rate. It's about a risk that you're having to manage. So don't think about it trying to punt and always pick the absolute lowest rate all the time and then be able to sky it at the barbecue. Think about what risks do you want to avoid? You know, is it really important for you to minimise your debt servicing costs as much as possible? That might give you one strategy. Yeah. Just with the right here, right now.
I think everyone doesn't want to spend less money.
Yes.
Right. That's the bottom line.
But sometimes your trade-off might be is you could fix for 1 year and that might be quite a low rate, or you can fix for 2 years and that's a higher rate. If your priorities are more on right here, right now, it's important for me to minimise my debt servicing costs, so I'll choose 1 year. But another person might be, look, we might be having a baby. I want to get some security over what my costs are going to be. I'll fix for 2 years or I'll fix for 3 years. If you have a rental property or even, say, a commercial property that you own, which has, like, say, a lease term of a certain period of time, so you know what rent you're getting over that period of time, you may choose to look at an interest rate term that roughly matches that. So you've got certainty of what your income is and you've got certainty over what your debt servicing costs will be, and you can kind of lock in and know, okay, for the next 2 or 3 years I can sleep soundly knowing that property is going to be profitable. So there are all those considerations that people need to think through. One thing it's worth people knowing that, at least at ASB anyway, if you have a fixed rate mortgage and it's coming up for renewal, you'll usually ahead of time, I'd say about 4 weeks ahead of time, get offered some interest rates at which you can choose to refix ahead of when that comes up. And what ASB will do is let's say you choose a 2-year term and it's, say, for argument's sake, 5.5%, and then by the time you go to actually fix the mortgage, if the rate's gone down, the bank will honour that. If the rate's gone up, you've locked in your rate. So one thing to do is think about things like that, because at a time when rates could be going up, that's one way of just being able to make your decision a bit earlier without too much cost.
What about lending from banks for like first home owners and stuff like that? Like, is that going to be impacted by the shock that we're getting right now? Is it going to be harder to borrow money to buy your first home?
Where it can make a difference is, if the Reserve Bank, puts up interest rates, well, basically if mortgage rates lift up, the main thing that it's going to do is it just means that your income won't go as far in servicing a mortgage. So one thing to bear in mind is that when banks are assessing mortgage applications, they will be sort of testing your ability to service debt by applying a higher interest rate than what's available right now. Because
what is it typically? Like if let's say today is 3, how do they test? Do they test with 5?
Well, let's say probably a good rule of thumb. It's a really crude rule of thumb would be probably a couple of percent higher than say the floating mortgage rate. As an argument, that's not.
But what happens on the ground at the moment? Like with even with the banks, like. How do they think? Because then people can plan accordingly.
Yeah, well, you at the moment, banks are probably, from some, I guess, figures that I saw probably a few weeks ago anyway, using an interest rate somewhere 6.5%, upwards of 7%,
right,
to test people's servicing ability. And the reason they use a higher rate than what's available now is because what it's doing is it's just making sure that, okay, let's say interest rates went up a couple of percent. Will your income still enable you to service that mortgage? Because the last thing that banks want to do is lend you money and then you wake up the next day and you go, oh, hang on, actually, I can't afford this anymore, because then, the person who's borrowed the money is in a really rough position.
Yeah.
So there's always that sort of buffer put in to try and allow for the fact that interest rates could go higher than where they are when you take out that loan. And that's, if you're borrowing right here, right now, that's pretty much the only way the situation could have an impact. Is if interest rates are creeping up, it just means that people's serviceability is a bit tougher. You probably might not be able to borrow quite as much, but that's about it. The only other real things are, the Reserve Bank still has, restrictions on the ratio that you can borrow relative to the value of a house, which applies sort of across the board. So whilst there are some small exemptions, generally you still need roughly a 20% deposit in most cases to buy a house. But there are exemptions for things like new build houses where the Reserve Bank exempts them from higher restrictions of requiring a higher amount of equity or a higher deposit.
Yeah. Interesting, isn't it? I got reminded to ask about your accuracy when it comes to seeing what's going to happen. I feel like, were you the one who won an award for having a successful prediction of how the economy is going to look like in the future?
We have, yes, there is it's an organisation that's perhaps won't be well known in New Zealand, but there is an organisation based in London called Consensus Economics, and they do surveys of economic forecasts pretty much for just about every country you could think of, and publish those, and that gives people an idea of, it's like they collate up an average forecast for different countries. And they started some time ago assessing how well people were doing. So if you're doing forecast for 2025. They start surveying you at the start of 2024, all the way through to the end of 2025. So you spend 2 years providing forecasts of 2025, and they started looking at, well, how good are your inflation forecasts? How good are your growth forecasts? And we've won since, I think they started doing it in 2013. We've won 4 forecasting awards, and I think they'll be giving out the latest awards for this year in June.
That's very impressive.
It is, but I have to say that. But look, we've also got to be humble as well, because the thing about economic forecasting is you're basically trying to be roughly, approximately right, not horrendously wrong, because it is a bit more of a dark art than a science. So just trying to get the general direction right. So they're just giving people an idea. This year should be better, or be a bit more cautious because this year could be slower. That's, I think, where the value, the value in what we do is we're trying to help people understand what has been happening and why, what could happen, and what are the things to watch for that will signal that will happen or not.
Based on that, then, what have you been forecasting for 2026, and what does that look like for people?
Well, for what we call economic growth, GDP growth, before the crisis hit, we were thinking like 2.5-3% growth, upwards of 3% growth.
Is that healthy? Or?
That's pretty good when you're at a time when our population growth, has slowed compared to sort of previous times, and our productivity growth is also quite slow.
Right.
So we're looking, actually, that's a pretty reasonable recovery, even if it's taking a bit of time to build up that momentum. And look, now we're thinking, look, we'll still grow over the course of this year is our view, but it's probably going to be somewhere between 1.5%. So that's and probably taking a bit of a knock in the short term whilst we all get that sort of cold shower of realising that we're paying so much to fill up our cars as well. So look, that is a change. Like, we're still at this point saying, yes, we're going to grow, but it's going to be a bumpy ride through the middle parts of this year. Because it's not just about how much money we've got in our wallets, it's also about how we feel. So if we're in a time of uncertainty, often the decision people make to do is to do nothing. So we put off buying things. If you're a business, you might be putting off hiring someone, expanding your headcount, or even just replacing someone who's just left. You might have been going, right, well, we're going to buy this nice big shiny new gadget for our company. Like, we'll just hold off and we'll wait and see. So in the short term, we do have that risk that we just sort of hit the pause button a little bit and defer decisions, and that can, that decision can slow the economy for a brief period, because if we're not out buying or doing things, you're not getting the same level of activity, which is income for other people.
Yeah. So this is the prediction, or the rather forecast. Do you have a Q or quarter forecast? So we're in Q2 right now. What do you expect for Q2, and then third quarter, and then the fourth quarter? Do you have any sort of extrapolation of information?
Yeah. So look, any figure we give at the moment is probably going to be out of date within about a week, the way things are going. But look, in the second quarter, the June quarter, which we are in right now, bear in mind we haven't even got the first quarter growth figures yet. We don't get them until...
When do we get them?
We'll get those at the end of in late June. It's a long lag.
Yeah. How come?
It just takes a long time when you think about it. You're trying to survey and estimate all the activity that's happened in the economy over a 3-month period. So it's a lot of data to compile.
Yeah.
So for the second quarter, look, we think there could be a dip of a few tenths of a percentage point. So just at that time when sort of like retail spending probably drops a little bit, we have businesses just pausing a little bit, and then sort of weak growth, probably just reversing that in the third quarter, the September quarter. We are making assumptions, because that's all anybody can do in these days, that oil prices will start to fall after September, that they'll remain high, give or take, through to the end of September, and then start gradually falling, and that will help boost growth. And the other thing is that at the point where oil starts to flow again, it looks like the conflict is winding down, we're going to feel a bit more relieved, we're going to feel a bit more certain, we're going to be a bit more prepared to act than we probably are right now, where we're all still trying to understand what's happening, how is this affecting my business, what should I do differently right now?
Yeah. Let's think about two scenarios where the war gets worse and worse and worse. And then the other scenario would be the war gets better and better. Obviously, we know what's going to happen if it gets better and better, because things will get back to normal. There'll be a bit of a lag with hopefully recovery. But if the war really genuinely gotten worse and worse, like come October, there's no stabilization, the oil, there's still shocks, and we run out of fuel. And what happens to an economy in that situation?
So let's assume that we've still got global oil supplies are weak, gas supplies too, fertilizer. There's many other impacts will start to show up. But first of all, like oil for us, if you've got very low flows coming out of the Middle East, there's some that can bypass the strait. Not a lot, but there are some oil pipelines that give some alternative routes, but it's not going to make up for losing 20% of your world supply. And the gas supplies, you really just can't get that out any other way than a ship. And it has to pass through the Strait of Hormuz to get there. So countries in Asia which rely on gas to generate electricity, will have to be thinking pretty hard about electricity conservation, for example, or trying to switch to burning coal as an example, to make sure they've got enough electricity. We don't have that problem too much, fortunately, but that's just another dimension to it if this goes on for a long time, because you're getting quite an energy crunch. And fertilizer, where that could impact the world, and including here, is that as we're getting around to, say, doing a lot more planting later on this year, fertilizer is going to be potentially a lot scarcer and expensive, so we won't be able to use as much, or it just won't be profitable to use as much. So that's going to impact on, say, our farming sector in terms of their sort of like crop yields, or how much grass they've got for their livestock to feed on. So that's an added dimension there. For us, if oil supplies are quite constricted, we may find that we end up at some point needing to conserve our usage of oil. About 40% of Asia's oil needs, at least, rely on the Middle East. The vast bulk of the oil being exported from there was going to Asia, and the places that we source our refined product from are places like South Korea, Singapore, those two countries in particular, Japan, I think Malaysia as some examples, and they are not getting that feedstock coming through, that crude oil coming through. So South Korea and Singapore relied on the Middle East for about 70% of their crude oil, which they refine, use some of it themselves, and export to places like here. So if we've got a prolonged global reduction in availability of oil, someone's got to go without.
Who is that going to be?
It's going to be probably more in the developing world, unfortunately, because they'll hit a point where they just feel they can't afford to buy it, just from a cost. Now, that's the thing with the price going up. It's basically telling people to, one, use less. It's just everybody's competing for a scarce resource. And what happens when you do that, you're pushing the price up, and that's really what we are seeing. So we may run the risk that we don't get quite enough, but we certainly, even if we can, it's going to remain very expensive. And we're going to need to learn how do we adapt to that. We're very inventive as a species. We adapt and change. And if this turns out to be something that's not over and done with in a short period of time, we will needing to be thinking really hard about, say, how we use our energy, like particularly as households, because we're going to want to get as much diesel as we can, because that's so critical. So we may have to change our travel practices a lot. Even simple things like if you're relying on plastics and that's containing, oil, that's oil-based plastics, looking at alternative uses for things like that. Farmers having to look hard about their farming practices as well. And it will be relatively painful if the global economy is still missing that chunk of supply, because some of our key export destinations like China, which has a lot of oil reserves, fortunately, but it exports to the rest of the world. It earns from everybody else's preparedness to spend. And South Korea and Japan are also relatively large trading destinations, and they're very dependent on energy imports. And so what happens to countries like that? What happens to their consumers' ability to spend money? What does that mean for our exporters? So you'd likely have a lot more of those longer lasting impacts come through. It means having to really think and adjust.
Yeah. So if we can't get oil from the Middle East, are you saying that we can get oil from other countries?
So one thing that a price is going up says is if you can produce more oil, produce it. And so one thing we are seeing is it say in the US, they have the ability to export a bit more oil.
Yeah, because they have, obviously they're not, according to their sources, they're not worried about losing they're not worried about oil. So they're like, oh, we're good.
They sort of are and they sort of aren't.
I actually don't know what the truth is, because this is what we see on the outside, but there's always maybe another story. But my question is, if the problem continues and we get to a point where there's no fuel, changes of practices will come into place, but isn't there going to be like a massive disruption, like a destabilization of society, of like people can't do their jobs and can't work around? Like there's going to be like a halt.
It's definitely the risk in some countries, just even simple things like if you've been relying in Asia on using LPG for your cooking, and all of a sudden you don't have LPG, what are you using for cooking? Are you going back to using charcoal, for example, wood? You're suddenly scrambling for fuel and things like, those key things in life we need, like food and shelter, keeping warm, all those things are really important. And, things like civil unrest do become more of a risk in places if you don't get some of those things. So societal upheaval can, if you're really starved of energy, you will get issues like that coming through. One of the reasons, like say in New Zealand, like say the police force and emergency services are very high up on the list, priority list of getting fuel is look, you can't afford to have law and order break down, as an example. And so when you get disruptions like this, it brings in those added dimensions. I don't think we're in any remote likelihood of having shortages to that degree. Yeah. But around the world, there are going to be pressures coming on people. But the longer it goes on, the more we're going to have to adapt. So that will be other countries working out how they can produce more oil, like say the US, Canada, Africa, parts of South America, and that might help fill some of that gap and mitigate it. But it's very hard to do that quickly as well. We're getting some adjustments happening now, but it takes time.
And gosh, it's just interesting, isn't it? Interesting how the world is working and what 3 countries can do to the whole world, and how funny it is that it cannot be stopped. It's almost like but like only a few people have control over things, right? Like it's almost like it's very scary as to how fragile life is, not just from a health point of view, losing your life, but like at any point you can get told to stay at home and do nothing, can't travel anywhere, or at one moment notice there's fuel is really expensive. It's almost like, I don't know, it's funny. It's funny how life is working.
I think when we sort of step back and look at it, the world is changing. I think we got used to a period of great stability after World War II. You did have the Cold War, which was like a huge amount of tension for a period of time, but there was actually a lot of stability for a long period of time. We developed, the sort of post-World War II, I guess like what we call the rules-based order. We set up rules of how we trade and how we get on with each other. And that worked really well for a long period of time, but it has been starting to fracture bit by bit. Yeah. And I think what you are seeing, particularly the US role in this is dramatically changing, and we are moving away from that. We're getting more of this, I guess, what we call geopolitical instability, which is countries going off and doing unpredictable and not so desirable things, whether it's Russia invading the Ukraine, whether it's what happened in the Middle East, with the October 7 attacks, which has sort of sparked some of this, and the US has got a completely different approach to things like trade and its relations with people. So now we're in an environment where you have, COVID was a virus, the global financial crises that I've seen, it's been like an overheating of areas. But this is where you're getting down to governments or a few people making some decisions that have fundamental impacts on so many people. It's a very different risk environment we're in now, where our economies are very much being knocked around by all these sort of like political seismic shifts that we are seeing, and we're going to have to get used to it, and we're going to have to get used to the fact that we're going to keep on getting hit by uncertainties and shocks and shifts, and we can't just sort of sit back and wait for things to the dust to settle, because we just keep on getting hit by one thing after the other, and we are really having to learn it, just going, okay, what is this going to do to me? How do I adapt to it? And keep figuring out ways to move ahead. And it's a shift in how we do things. It's going to be a shift in how our government interacts with other governments. And
perhaps New Zealand can just become an independent country, not needing so much the reliance of shipping things to other countries to make money, like becoming more resourceful within it. But I don't know if that's even going to be possible to make it a very strong economy.
Well, it's one of the pluses and minuses of globalization that we've had, well, particularly free trade. Look, as an economist, economists are good for on the one hand, on the other hand, but one thing that the vast majority of economists agree on, things like free trade is really good for our collective prosperity, and the rapid growth in global trade has just helped enrich the wider world and bring a lot of developing countries up, emerging economies up to be a lot wealthier, like Japan, China, South Korea, Taiwan, Singapore.
Because isn't Singapore has the same population as us?
And it's done incredibly well by becoming a trading hub. And to contrast also, it's been a bit more of a directed economy as well, even though it's
what do you mean by directed?
Directed. There's been a lot of heavy sort of government direction of what industries and support for industries, whereas in New Zealand and the UK and the US, Australia, we're a lot more. We'll let people decide. So you've had a lot more of that cohesion, government, central government directing, heavily, economic policies.
Oh, okay.
In a way where you haven't had here, to support industries and get things going up. At a trade-off, maybe at a little bit of a loss of freedoms in some ways.
What is your final thought about where we're heading right now? I mean, we did cover a lot, but I'd like to find out from you. Yeah, final thoughts.
I think the first thing we all need to recognise is none of us know exactly what's going to happen. We do know we're facing a period of high energy prices, high plastics prices, other things like that. We will need to adapt to that. We just don't know how long. So if you're running a business, the key things are, it's hard, don't potentially plan on, okay, this is going to happen at this point, this is going to happen at that point, this is going to happen at that point. Really think through those sort of what-if scenarios, and that's where I think it's really important. Scenarios, getting a sense of what good looks like, what okay looks like, what terrible looks like, and how do we really defend and mitigate that for our business. Think through those things, a bit like, in some ways, I hate to use the word, a bit like in COVID, but we got, I think, as a country, much better at starting to understand how there could be different possible paths that could look quite different, and thinking about what actions we would take through those, so that we're starting to make kind of more informed decisions where we've had a bit of time to think about them. So that scenario planning and contingency planning is the sort of thing that is going to get us through this. And look, we will get through this. We have massive amount of shocks over time. They are not fun when you're in them necessarily. I think the key thing is focus on what you can control. Don't catastrophize too much. Don't overreact to headlines, because as you can see, the popular phrase these days is taco. Trump always chickens out. Not necessarily, but it's just that whip soaring around. One moment it's this, one moment it's that, and you're not going to be able to make a decision if you are focusing on the noise. So really cut through to what fundamentally matters for your business. Understand that. Understand your supply chains above you, the stuff that you are relying on coming in. Understand the supply chains going out the other way, which is, if you're exporting, okay, how are you exporting? Which countries is it going? Is it going through? What shipping lines, for example? So you're getting a better sense of where your risks are lying. Think through those things. Just really focus on what can you do to make a difference to running your business, understanding all the various risks. Focus on how you control those.
Nick, it's been great to have you. Thank you for the enlightenment and the clarity. If people want to reach out to you or, want to connect with you, how can they do so? Well,
probably the best way to get a sense of what are we doing as a team is if you go on the ASB website and you've got one of those, I guess they call it the hamburger. Well, there's got that the search bar, and put in sort of economic research, and you'll come up with all our reports and our details.
Sounds good. Well, it's really good to have you. Thank you for making time for a chat.
Thank you very much for having me.
You're welcome.